QuickBooks Online 2021 Invoice Form. Let's get into it with Intuit. QuickBooks Online 2021. Here we are in our Google search page. We're searching for QuickBooks Online Test Drive. Then we're going to be selecting QuickBooks Online Test Drive from Intuit. It's then going to ask if we're a robot. I was once, but then I made a wish upon a lucky star. Now I'm a kangaroo, so we're good. Going to check that off. Continue. We're now in the Craig's Design and Landscaping Practices file. In prior presentations, we've been taking a look if we hit the new drop-down, the information in the Customer Center, and we want to memorize or think about the flow that's going to happen in the Customer Center, then take a look at the individual forms. We're now going to do that within the forms here, looking at one of the major forms, that being an invoice form. Before we do that, however, let's take a quick look at the flow chart. I'm going to go to the desktop version. You don't need the desktop version here. We're in the online version, but we have the flow chart, which is nice on the desktop version, where we see the full flow of an accrual type of process that would happen depending on the type of industry you are in. So if you're in an industry where you do the work before you get paid, like a lawyer or an accountant or something like that, where you have to do the work, you have to bill the time that's going to be out there, and then charge the client, then you're going to be creating an invoice, increasing the accounts receivable, and then increasing the revenue at that point in time. Then we're going to have to receive payments on it, and then we're going to basically make the deposit of that payment into our checking account. So the invoice is the first of those series of transactions that would happen. Obviously, when we receive something like a bill, like a utility bill, a telephone bill, and so on and so forth, to the person who sent it, in QuickBooks terminology terms, it would be an invoice to them, and it would be a bill to us. And that's the first thing we kind of want to consider, and we always have to keep in our minds. We know that every transaction has two sides to it. When we're looking at QuickBooks, we got to be understanding exactly what their terminology is to tell us which side of the transaction we are on. So in other words, an invoice is also a bill, but when we're thinking about QuickBooks terminology, the invoice means that that's something that we're going to be billing our customers for, and the bills that we receive, or invoices that are from others that we're going to receive, we call a bill to us. The bill for QuickBooks means that we're the recipient of basically an invoice that was sent out by somebody else to us. So now we're talking about the invoice, which is basically a bill that we create for the goods and services that we do. When we create the invoice, it's going to increase the accounts receivable and increase the sales item or revenue. Let's go on back over to our QuickBooks here, and let's just take a look at one. There's multiple ways to get to the invoice, but the most common way is to hit the plus button up top or in the customer section. We're imagining that we're basically sending a bill to the client for work that was done in the past that we expect to receive in the future. We will then create an invoice. The first step of the invoice is to pick a client. Now, if we already have the client set up, meaning we've done business with them in the past, we want to select a current client, or if not, you can actually add the client as you go up top. So we could add the client here. I'm just going to call it Customer 1. And that's all you really need to make the invoice. However, of course, if it's a customer and you expect repeat business for them, then you're probably going to want more detail for that customer. So any added details that you can have for the customer, you can open up the added detail field here and add more information for the customer, including the email address, which can make it easier to then send the information, including the invoice in other forms. We'll go through the setting up of customers in more detail in the second half of the course when we add more customers there or start our practice problem. So I'm just going to call this Customer 1 then at this point, and we'll keep it there. I'm not going to have an email address. The billing items down below, only showing the name here because I didn't add the billing information for that particular customer. The term then means when it's going to be due. So if we're sending basically a bill to somebody else, invoice bill to somebody else, when's it going to be due by? The default often being that 30 days. That's going to be the due date. So in other words, if I send this out on January 5th, then the due date 30 days later is going to be February 4th. So it's calculating that end date based on the terms, in this case, the net 30. So we have the standard terms here, net 10, 15, and 60. You could set up different terms if you so choose. I'm not going to have any crew number. We've got the tag number, not going to include a tag number. And then we've got our products or services that we would then be including down below. These are going to be the items that make it really easy to populate an invoice. So what you want is for someone to be able to populate an invoice without knowing much about how to add the items that are needed to populate it. For example, how to add inventory items or how to add the service items that you're actually charging for. And so they can just enter the data input so that you can delegate to somebody else to just do the data input. In other words, if you think about someone like ringing up the information at like a cash register or something like that, they're ringing things up that can have very complex kind of transactions related to them, but the ringing up process of it with like a cash register is quite easy. And we want a similar process with our invoicing process. We'd like to be able to delegate to someone to create invoices without having to know the things that need to be done to make the data input as easy as possible, or the effect of the financial statements on, or the invoice on the financial statements. If they do know that, that's great, but we want to make the data input as easy as possible. Part of that is to set up the products and services. Now, we'll talk more about that in future presentations when we get into building our company file. When you're taking over or looking in or working on a company file that has already been set up, then most likely these products and services have already been set up and the data input should be easier to do at that point. So these are going to be the things that we sell. And here we got a kind of like a construction customer company. So we got concrete, design, gardening, landscaping, and whatnot. That kind of stuff is somewhat of a specialty area if you have a contractor, because you might be using more of a job cost system and whatnot. We have a course on job cost systems if you want to get into that in more detail. But you might have a service company and then you don't have to deal with inventory, or you might be selling basically inventory, a wholesale kind of purchasing and selling inventory, marking up and selling inventory. Let's just add another account for one of each. So what I'm going to do is I'm going to add another item. You can add items basically as you go, or you can go and add all the items at once. I'm going to do this quickly because we'll spend a lot more time on adding items when we do the practice problem. So I'm going to add a service item down here. And then I'm just going to call it service item. And I'm going to say that this is going to be the service item. And you could think of this almost as hourly if you wanted to think about it. Your service item might be your hourly rate or something like that. But I would recommend thinking about doing something that is more standardized than your billing system, even if you're an accountant or a lawyer who often do hourly systems, because it could be a lot easier, save a lot of time if you can kind of standardize what you're doing into chunks so that you can tell the client, hey, look, this is what we're going to do and this is how much we're going to charge you for it. For example, if you were to say that you're doing bookkeeping services, instead of saying I'm going to charge you by the hour, I might say I'm going to run a transaction report and I'm going to charge you by the number of transactions. If you're in this range of transactions, this is how much it's going to cost. And that way it's a little bit more concrete on both sides and your billable hours might be easier to deal with. So I'm not going to put the sales price right now because I'll put that in later. And then we have here a service income item. So that's going to be the income account that would be affected. And then we got the sales tax category. I'm going to say this is not taxable. In the United States, oftentimes the service items are not taxable. So I'm going to say non-taxable. And there we have it. So I'm going to say save it and close it. Save it and close it. And let's just make this $1,000 then. And so there we have it, $1,000 being charged for the service item. And then down below, we've got the add lines. If necessary, you can have multiple lines. So I might have another service item or some other item down below. So we can have a quite long invoice in that way, especially if you're in something like a construction company or something like that, where you're basically listing out a whole lot of things that are going to be included on the invoice. So if you need more lines, you can add more lines. You can clear all the lines. You can add the subtotal here. Then you can add messages down below, message on the statement, and then we can have attachments if we so choose. We've got the subtotal down below. We didn't charge any sales tax in our case because we're saying it's a service item and we're not subject to sales tax. Therefore, this is going to be an easier type of invoice. That's going to be the total then. What's this going to do when we record it? It's an invoice, therefore we're going to have an increase to the accounts receivable. That's what an invoice does. That's a balance sheet account representing people owing us money. The other side, then it's going to go to revenue, and it's going to be driven by the account here in terms of which revenue account it's going to go to, but it'll be an income statement account or P&L profit and loss account, those being the same thing, income account, profit and loss. Let's check it out. Let's save it and close it. Save it and close it and check it out. I'm going to duplicate the tab up top so we can open up our favorite forms, those being, or reports, income statement, balance sheet, the financial statement reports. So I'm going to right click on the tab up top and I'm going to duplicate the tab. Let's duplicate it. And then we're going to be opening up our favorite report, the balance sheet. Of the two, I'm calling the balance sheet the favorite, although the balance sheet and the income statement are probably both, tied. You can pick one or the other as your favorite report, but it pretty much has to be one of those two because those are the major financials. So I'm going to pick the balance sheet first. So there's going to be our balance sheet report. I'll keep the date range in 2021 because that's when I entered the transaction. So I'll keep that there. I'm going to go up top. I'm going to right click again and duplicate again and open up the other favorite report. And that's going to be the profit and loss or income statement report. QuickBooks calling it the profit and loss report. In accounting terminology, more often you'll see income statement. So you just got to know those two terminologies. P&L could be called the P&L for the profit and loss as well. If you want to sound quick, if you don't have much time, like when you're saying stuff and you want to say it fast. So then I'm going to hold down Control and zoom up a little bit. So we'll zoom into this and then let's go back to the balance sheet, close the hamburger, hold down Control and zoom in a bit. Okay, so the accounts receivable then has been affected. If I go to the receivable account, going into the receivable, that's the account that shows people owing us money. I'm going to hold down Control and zoom out a bit now. There's the 1,500. There's the 1,500 transaction invoice. That's what's going to be increasing the AR always. Accounts receivable increases by invoices, basically only. And then that's the only thing that increases them. And then there's the customer, there's the other account affected, or I'm sorry, this is the account, this is the split account, which could include the other account, but sometimes there's multiple accounts, so they have a split there. If I click on this using the zoom feature, then we have our two transactions. And I think because we have two items here, that's why it had a split account, even though both those items are going to basically the sales line. So there is that. If I close this back out then, the other side should be going to sales. So I'm going to go back up top. I'm going to go back to my report, clicking this little blue button. I got to scroll up and click the blue button to go back to the report. Then we'll take a look at the income statement. Income statement, there's the 1,500 on the income statement under services, increasing the revenue account. And there it is. Now notice here, it broke it out into two transactions because we had two separate items included in the one invoice. And that's why it showed that split instead of just one other account in the accounts receivable detail. But if I click on it, it's going to go to that one invoice that had those two items within it. So it's kind of breaking out the items, even though it's generated, both items generated by the same form, the same invoice. So I'm going to close this back out. So there's going to be the two sides there. I'm going to go back up top, go back here. Now, if I go to the first tab again, our balance sheet, this balance sheet report shows us who owes us money. We also want to know who owes us the money. And we saw that basically in the customer tab or in the sales tab or in the customer center. You can search for it there. We also have another report that can give us the detail. Note when I go into this report detail by zooming into it, it doesn't give us any more detail that we really need. It gives us detail by date. We need detail not by date of transaction, but by who owes us the money so that we can, harass them endlessly until they pay us. So what we're going to do is right click on this tab up top again. Let's duplicate it again and make another report. This is going to be supporting the accounts receivable report based on who owes us the money. So I'm going to go down to the reports again. And remember, all other reports other than the major financial statement reports, balance sheet and income statement, in other words, are supporting to, in some way or another, a line item on the balance sheet or income statement. So if I go down to who owes you money, we're going to say, I want to see the customer balance, let's say summary report. We'll go to the summary one. Let's go to the detail one. I should have hit the detailed one. I'm going to go back. I hit back. I changed my mind. Sorry. So I'm going to go down to who owes you money. And let's go down to the customer balance detail. That's the one I want. I'm not going to change it this time. That's the one. So there we have it. Now we got our information by customer up top. And I think this is our new customer one. There it is there. And the total down here then should tie out that 678152 ties out to the balance sheet right there. 678152. So that's what we want to see. So then if I go back on over here to our first tab, let's make a little bit more complex type one here now with inventory. We're going to put something in there that has inventory, which complicates the balance sheet or the calculation a lot. So if you do not have inventory, your invoices are fairly easy because you may not be dealing with sales tax then, and you may be, you don't have to track inventory. If you track inventory, then it's going to be a bit more detailed. And notice, again, if I go back to the flow chart over here, if you track inventory, the question is, do you want to track inventory on a perpetual system, or do you want to track it on like a periodic system? If you're doing a perpetual inventory system, then you're going to have to record the inventory when we purchase the inventory. You'll typically use some flow assumption. The QuickBooks Online, I think, uses a first in, first out flow assumption, whereas the desktop uses a weighted average assumption. And then every time you sell something with an invoice or sales receipt, it will have to decrease the inventory and record the related expense called cost of goods sold at that time, which complicates the transaction a lot, but it gives you that real-time information. Or you could basically do it in a periodic way and basically record the invoice without doing the cost of goods sold and inventory side, do a physical count of the inventory at the end of the day, week, month, and then record the adjustment or decrease in the inventory of that you sold based on the physical count and the related expense cost of goods sold periodically at the end of the day, week, or month, or something like that. We're thinking about now doing a perpetual system, meaning we're tracking the inventory in the system in some way. When we then create an invoice, we're going to have to decrease the inventory at that point in time because that's what we're selling. So I'm going to go back on over and say, all right, well, let's make another one and pretend we're going to be decreasing the inventory now. So I'll make another invoice. And I'm just going to call this well, let's keep customer one. It's fine. Customer one. And I'll keep it on the same day here and everything. But then down here on the product, I'm going to set up a new one. I'm just going to call it inventory. Inventory item, which we would probably want to be more descriptive in terms of what we're selling. But I'm going to sell an inventory item. That's the point. I'm just going to call it inventory. Generic. I know I should be better, more detail. I got to put some inventory on hand. So in practice, we would purchase the inventory and then sell it here. So if I didn't have any on hand, I couldn't track the inventory. I'm going to put some on hand at this point in time just to practice with. So the initial quantity, I'm going to say, is 500 units as of, we're going to say, I'll say the beginning of 2021. Reorder point, I don't need that. Not going to do it here. We'll get into this in more detail in a future presentation, how to set up these items. And then we have the inventory asset. That's going to be the account that will be affected when we purchase it. The sales price, I'm not going to put anything for now. I'll add it when I create the invoice. And well, let's add it now. I'll add it now. Let's say it's 2,000. And then the sales product income, and it's going to be a taxable. So this one's going to be taxable. That means it's going to be subject to sales tax. And then the purchasing information will be here, and the cost, I'm going to say we're selling it for 2,000 and it costs us, let's say 500. Well, let's say it costs us, it costs us 1,000. So we're buying it, let's say 1,500. So we're selling it for 2,000. We're buying it for 1,500. That's how much it costs us. So then I'm going to say, all right, save it and close it. Save it and close it. So now we have that one item there of a quantity one. We could change the quantity if we so choose, if I had two of them. So now we've got 4,000 here. And that's going to be our basic inventory item that we're selling. Now, this is going to be a little bit more complex of a transaction. What's going to happen in this transaction? Well, we have the same starting point. Invoice means accounts receivable is going to go up. It's going to go up by the total amount, including the sales tax of the 4,320. The other side is going to go to revenue, the sales line item, but it's only going to go up by the 4,000, the amount that we actually charged. The difference, the 320, is not going to go to the income statement because we didn't really charge that. In theory, the government is charging the customer, not us. It's not our sales. We're not going to record a sale and an expense related to it. We're taking it off the income statement entirely. That 320 then increase in the balance sheet account for sales tax payable, a liability account, some type of liability, a tax is payable. And then we also have cost of goods sold that is affected by an amount that's not on the statement because we don't want to show it to the customer. But the system knows about it because we set it up in the inventory item. Just as you would expect if you went to a grocery store and someone, or you rang up or someone else rang up the groceries, you only see the sales price, but the system is also recording the cost of goods sold, the expense of the thing that is being sold. That's the same thing as happening here, but you can't see it on the form. And then the other side is going to be decreasing the inventory, once again, for the cost of the inventory, not the sales price. So let's record that and just check that out. Let's save it and close that. And so the invoice is, if you sell inventory and have sales tax, the invoice is actually somewhat of a complex form. There's a lot of things going on, and it's not as transparent to know what they are because some of it is not on the actual invoice. So if we go then back to the balance sheet, we can say, okay, well, I know the accounts receivable should be affected. So if I go into the accounts receivable, we see that 4,320. That's for the full amount, including sales tax. If I drill back down on it, I'm going to say, all right, there's the 4,320. That makes sense. The other side should go to sales, to the income statement, or profit and loss. I'm going to scroll back up, go back to our report summary. So I'm back to the balance sheet. Then I'm going to go to the income statement on our tab to the right and say, okay, what happened to the income statement then? I need to refresh it, I think. So I'm going to refresh the income statement. And notice on the balance sheet, if I go back to the balance sheet, notice I had the 11,101 now. So before I drilled down on that number, it probably wasn't 11,101 because I hadn't refreshed the screen. So now that I've refreshed it, it's at that 11,101. Profit and loss I had to refresh because this is in a separate account, another income account, but a separate one, sales of product. If I then go into this, I see that 4,000. That's not what we are ultimately charging because we had to include sales tax. So if I go into that, we see the 4,000. Now, if you know debits and credits, or if you want to think about debits and credits, you don't have to, but if you want to, this would be a credit. The receivable would be a debit. And this only went up for 4,000. The other went up for the full amount of the 4,320. The difference is 320. Where does that go? That goes on the balance sheet because it's a liability, because it's not ours. We have to pay it to the government. They're just using us to collect their money for them, and then we have to give it to them. So then we're going to go back to the first tab and say, okay, that should be a liability then. It should be a liability down here. There should be some kind of taxes payable that we got to pay to the government. And it looks like it's down here in the Board of Equalization payable. Now, I wish they would just call it, sales tax payable or something like that, but they actually list who you got to pay, the government agency that you have to pay, which might, be a useful way to do it if you have multiple sales tax items, but it could be a little confusing. But if you go in there, then you got the sales tax, there's the 320. So that's what we got to pay to the government, right? We're paying that to the government because they made us collect it and pay it to them. We didn't want to, but we had to. So then we have the inventory should be decreasing. So if I go back up to the inventory, here's the inventory items. I'm going to select the inventory items here and say, all right, so then we got our inventory. We have that decrease of the 3,000 of inventory. That 3,000, if I click on it, is not on the actual invoice that was used to generate it. How does the invoice know what that 3,000 is? Because that's what we set up the cost to be. For one of, half of that was one of these items, 1,500 for each one of these inventory items. So there is that side, and that's decreasing the inventory. I'm going to scroll back up, go back to our report. The other side then go into the balance sheet. So the income statement, the profit and loss or income statement in the form of cost of goods sold. There's the 3,000 in the income statement, cost of goods sold. Drilling down on that, we get once again back to our source document, that being in this case, the invoice. So I'm going to close this back out, scroll back up. What's the impact on the income statement then? It's going to be the increase of the 4,000 minus the cost of goods sold. of the 3,000. That's the net increase on the income statement. What's the net increase on the balance sheet? It's a little confusing on the balance sheet. You got the accounts receivable for the full amount, including the sales tax, but then is negated by a liability that is the sales tax, which is the liability on the sales tax, and then we decreased the inventory by, once again, that 4,000. Now, also note that this invoice will, if we're tracking the inventory, we have another report that would track the inventory. So you can go into your inventory reports or think about them. I'm going to go to the tab to the right, and then you can go down to your reports and have supporting reports related to the inventory. So if I scroll down to the inventory reports, so we have, well, let's just type it in here, inventory reports. We've got the inventory valuation detail, the inventory valuation summary. Now, I'm not going to go into those in detail because this is running a little long here, but those reports then should tie into then the amounts that we're going to be seeing up top, basically in the inventory line item here. So that's going to be the invoice. Obviously, the next step that we would have after we enter the invoice is going to be receiving the payment. I'm jumping over to the desktop version. We're going to go to receive payment. So we expect to receive a payment like in the mail, you can imagine. I think that's the easiest way to imagine. If I go back to the first tab, then I'm going to select this item. If I go to the receive payment line item, then receive payment, and then I type in, customer 1, then you see those two invoices that we just generated here would be in the receive payment. We'll talk more about the receive payment form and the effect on the financial statements, balance sheet, and income statement of it in future presentation.